Nice to see you. I'm sorry for whatever it was that you were supposed to be doing right now that got canceled, that you are coming here, to hear the riveting topic of insurance. But we'll try to make it as interesting as we possibly can. For those of you who are watching this remotely, I feel really bad that you're not here because I'll tell you the lunch buffet with the lobster tails and the oversized shrimp is to die for. Absolutely to die for. But that's okay. You'll enjoy something in your house, I'm sure. So we'll try to get through this and have a little bit of fun. Please, if you have questions along the way, interrupt me. Don't feel like you're going to wait till the end necessarily. I'm happy to talk this through. Let me, if I can, just kind of start with a basic disclaimer. And my disclaimer basically is that I'm going to speak kind of in generalities today based on my experience over the last 40 plus years in this industry and what we call the insurance services offices, the ISO products. ISO is an organization that writes the policy language for the industry. And then what happens is insurance companies modify that some, they do wording endorsements, they limit coverages, they do a number of different things. But ISO is that body in the industry that makes it kind of uniform so the consumers can kind of have some faith and some trust in what they're buying. So I'm going to talk at that level. But if I say something and somebody says, oh no, my company does something different, the answer is yes, I'm sure they do. Because every company then takes the ISO forms, state by state by state by state, and they file endorsements to, as I said, either broaden it, limit it, change it, call it whatever they want. So, as a disclaimer, when somebody says, oh no, Phil was wrong about that, yeah, maybe I was, because somebody broadened it or changed their coverage. So, when I was thinking about what to talk about today with realtors and homeowners insurance, of course, one of the first things that comes to my mind is, when should the buyer start to shop for their homeowners insurance? And the short answer is as soon as possible. First of all, as you all well know, your personal sales rep tells them to do that. It tells them to get going on this right away and try to get as much as you want. But there's more to it than that. There's more reasons to not leave it to the end. Several of them include things like there are a lot of carriers out there that will be urgency. Why'd they wait? What's going on? So if you can encourage your buyers to go as the person sales rep directs them to go, and get on top of this as quickly as possible, they're going to do better rate-wise. And the rate that they get doesn't expire, per se, with most carriers. So there's no downside to doing it 30 days ahead or 40 days ahead or something of that kind. In addition, they want adequate time to consider the quotes. There's a lot of information being thrown out. And, I don't know what I'm doing. We hear more folks who say the year after they buy the house, well, now I'm going to shop my insurance because they didn't give it the time necessary to do it ahead of time necessarily. And the other thing I hear from realtors all the time is this going to hurt my client's credit score? And the answer is no. They've legislatively protected that quoting insurance does not negatively impact the FICO score or the credit score for the buyer, right, Anthony? Correct. So tell them, don't be concerned about that. Even though some insurance companies all insurance companies probably, are going to be asking for their date of birth. Some insurance companies may even ask for their social security number. That's not going to negatively impact their credit score. Why are some properties more expensive to insure than others? And why do insurance agents, ask so many questions? Wow, we hear that all the time. My neighbor's paying blah, blah, blah. My cousin's paying blah, 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 blah. Why is theirs so much more or so much less than mine is? And there are so many factors that go into figuring out what this insurance cost is going to be. Some of them include things like their insurance score. Again, not their credit score. You could have a 760 credit score, but your insurance score might be, some company might call it a D or an E or an F or whatever it may be. Because there's something about it that the insurance industry doesn't match up with from a pure financial industry standpoint. It might be age, it might be marital status, it might be education, it might be any number of things that go into it in the back room and that what we lovingly refer to as that black box that we don't even know about anymore. Throw all the stuff in and out comes something, comes out this insurance score. The age of the house. Plenty of insurance companies like older houses, some insurance companies like newer houses, and if you try to get a rate on an old house from a company that really is focused on new construction, their rate's gonna be high. So the age of the house, the updates, the roof, the heat, the electrical, the plumbing, they're gonna be asked all these questions when they go calling around for insurance quote. And when they say the roof is 20 years old, or 25 years old, or whatever, that's gonna absolutely drop out certain carriers. Certain carriers are gonna say, no, we don't write any roofs over 15 years, or 12 years, or whatever is their underwriting characteristic. So those updates, the more the property is updated, the younger those updates are, the better the insurance costs will become. Losses, well, not only losses, they just say, I haven't had any losses because I just bought the house. Believe it or not, the losses to the previous owner too. The losses travel along with the house. So they'll look at a loss history through what they call a clue report to determine what's happened with this house. Has there been 3 water damage losses from the roof in the last 5 years? Has there been, 6 or 2 trees that have come down? You know, what's happened versus stuff that might be more specific to the previous owner. It's more specific to the risk and the characteristic. So they will look at previous losses for the previous owner, and your new buyer will at times feel, like they're being hurt by that matter. In some cases they are. Dogs. I know we've got the nicest pit bull that ever existed. I get it. It's a lap dog, it licks your face all day long, right up into the time it rips your face off. That's no reflection on pit bulls. I love dogs. I'm a dog guy. The average dog claim is $80,000. Because the average dog claim often involves a kid. And it's hard for them. And let it happen to the face or to an area like that.
Why does that go to us, our homeowners?
Liability. Pools. Again, some companies are very comfortable with pools. Many companies are not. I can tell you with pools, one thing insurance companies don't like very much are slides and diving boards. Okay, you gotta go swimming. We'll take that risk, but jumping off that diving board, coming down that slide is far more excessive an exposure than is the regular swimming. Trampolines. I don't know anybody who likes trampolines in the insurance industry. I can remember vividly one time many years ago sitting at my sister's house on Jamestown looking at the house next door, and we were talking about the fact they had a trampoline in the backyard, and no word of a lie, there had to be 10 kids bouncing on this trampoline, and not an adult within 200 feet. They were all up on the patio having a grand old time, drinking and having a wonderful afternoon for themselves. And I was sitting there just shaking, thinking about what's going to happen, which kid's coming off, which kid's going to break their leg. Heaven forbid something much worse than that. So insurance company, yeah.
So trampolines are very mobile. You can put them up, take them down. I could imagine a homeowner not telling the insurance company they have a trampoline, but then there's a trampoline accident. How does the insurance company respond? There's
no way to exclude the coverage, so they're going to pay in that scenario. Okay. Keep in mind, all of these questions are going to be as of the day of the application. So let's even play it out a little differently. The kids, 4 or 5 years old, now you've been in the house 2 or 3 years and they want a trampoline, you buy a trampoline. 10 to 1, the insurance company's never going to know unless they do an inspection. But the policy itself will respond to it. But on the go-in, when they're doing the initial rates, they're going to ask all these questions, and they're going to try to get a sense of, what's there or what's not there. But to answer your question, they won't deny it after the fact. They won't deny it unless you told you were inaccurate on the application. That's probably a really good point too, and that is that not that anybody would willfully or intentionally not tell the truth, but most insurance companies inspect the properties. You should know that. They should know that. Most of the time, we'll do an application for you today, And within the first 60 days, at least on a random basis, oftentimes even more than random, the insurance company will send out an inspector. And sometimes they'll run across that trampoline that you said no to. And lo and behold, there it is in the yard or something of that kind. The reason they use 60 days is because it's a window of time that they can get off that risk, even though they bound it in the beginning. Okay, so they're going out in the very early days. Then they will also periodically inspect the property. You may have been with an insurance company for 3 years, 5 years, 10 years, 20 years, and all of a sudden your account's picked for a random inspection. And they'll come out to see how the maintenance is and what's happening in the yard. Did you forget to call me about the pool, or any of those kinds of things?
So generally a less intrusive kind of inspection, like a drive-by.
Oftentimes it's just a drive-by, absolutely. Yes, sometimes it'll go inside, particularly based on age of the property. If the property is getting up there in years, oftentimes they will do an internal because they want to see the systems. But if it's just a random, they'll often stop with a piece of drive-by. Yes?
Yeah, I got a letter one time about I had a tree and the roots and the sidewalk, and I got a letter from my insurance company saying, fix it, we're gonna give you, I don't know how many days.
Yeah.
I was like, oh my God.
What do you mean?
Yeah.
And in those cases, we often see that, the homeowner rightfully says, it's not my sidewalk. It's the city's sidewalk. Well, that's true, but it's on your property. And they're just trying to avoid the finger pointing, whose responsibility was it when it happened? This guy could sit here all day long and give you countless examples of all the things the insurance companies detect when they come out. And they're not bad. I don't mean this like the insurance companies are being unreasonable. But of course, as the consumer, as the homeowner, you feel like that. You feel like they're picking on you. One of the real common ones we see all the time is downspouts draining onto the driveway. And the insurance company will inspect it and they'll say, you gotta divert that downspout off the driveway onto a grass area, blah, 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 blah. And the homeowner will be like, for God's sakes, the water just runs down to the street. Well, it does in August. Okay, let's talk about February. When it's icy. Now all of a sudden somebody takes a header and we're paying a liability claim. So there's usually some logic behind it, even if we don't want to agree with it. If it was our dollars, we'd be thinking the same way. Yes?
You just raised a point that I hadn't really thought about, sidewalks. I always thought that property ended at the edge of the sidewalk. You're saying that in most cases it includes the sidewalk as far as liability goes?
Yeah. Now, most of the time, if the sidewalk, your property goes to, let's say, the curbside, the street side, and then the city has the ability, or the town has the ability to do what they want for that first 10 feet or whatever it is. That's usually where that sidewalk lies. So if the sidewalk is in disrepair, it's going to ultimately be your responsibility if something would happen. I don't mean responsibility to fix it, but your responsibility to make sure that it's shoveled, it's kept clear and free of debris and that kind of thing. Normally what happens is if an insurance company, as an example, finds a sidewalk that's in bad shape and it's on your property, you say, Phil, what do? I tell you, first thing you do is call your council person and you get the city involved. And the city normally steps up, all the towns normally step up and take care of it. But again, the insurance company is trying to avoid that liability should somebody take a fall. Proximity to the coast, there's a huge one we've been dealing with for years and years and years. It's actually gotten a little bit better in the last 4 or 5 years, but we went through a period, I'm going to say 6 to 10 years ago, that if you were within 3 miles of the coast, by the way the bird flew, you were having a great deal of difficulty getting insurance. A great deal. And in fact, then into the marketplace came a couple of insurance companies that quote unquote specialized in coastal risks. They paid more, obviously. And they felt as though they were pricing themselves appropriately to cover that exposure. Things have gotten a little bit better in the industry. Now I would say if you're within a mile of tidal water, you have to have a bit of a challenge. But if you're at a mile and a half, 2 miles, 3 miles, most carriers have relaxed the guidelines a bit from that standpoint. And then fire protection. When I say fire protection, I mean both the city and town fire protection, as well as your own. That being said, your smoke detectors, which obviously are required by law, but the folks that go further and they get central station alarm systems, or they put in, sprinkler systems, the higher value houses sometimes we're seeing sprinkler systems, or that type of thing, all of those things will impact the cost one way or the other, good or bad. Why is insurance coverage different than the purchase price? And it all comes down to replacement cost versus market value. This is one we see with new buyers all the time. I'm paying $350 for the house. Why are you telling me I'm going to insure it for $450 or $425 or whatever it may be? We have, as an industry, industry standard calculator of replacement cost on houses, on buildings. And so the most used one is a company called Marshall, Swift and Beck. And they're an industry standard, they're out there, most carriers use them one way or the other. And they design the replacement cost by zip code to try and cover everybody's costs from whatever the marketplace is calling for at the time. This is huge right now, because replacement costs, as we know, or construction costs, I should say, as we know, has gone through the roof in the last few years. But even in relatively normal times, whatever that means, we often see replacement costs to be higher, or at the very least very different than our market values are. Inevitably, somebody throws up, how can that be? Because you're not going to pay anything for the land, and the foundation is still going to be there. And the answer is yes, both those things are true. But you're going to have other things that impact the replacement cost should the house go down. You got to remember that the whole concept of insurance is that, okay, I close my eyes and my house, heaven forbid, is destroyed tonight, that you're going to rebuild it for me, insurance company, and put me back into the place I was yesterday, tomorrow. And the insurance company, in order to do that, has to figure out what this replacement cost is going to be on the going. Now again, our lending partners may say, you got to cover mortgage. But that may not be adequate from an insurance standpoint. See, folks, when they buy insurance, they buy this. They buy a couple of pages that say, I insured my house for, $400. It's all of this language. And this language all says that there's requirements, there's things that the customer has to do in order to get paid in full at the time of loss. And it comes back to replacement cost. In there, in line 793, page 4, paragraph 5, blah, 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 it says that, hey, insured, you warrant that you're going to buy at least 80% of the replacement cost in order to get paid in full at the time of loss. Now, you're also never going to get paid for more than you bought for coverage. But then again, we talked about those endorsements, and then they offer these endorsements called guaranteed replacement cost. And the guaranteed replacement cost endorsement in there says that you have to guarantee and warrant insured that you're buying 100% of the replacement cost today. You're going to allow the insurance company to increase it at will based upon building cost indexes. And you're going to notify them of any significant changes you made to the property. And if you do all those things, then we'll guarantee we're going to rebuild the house the day after the claim happened. So when the insured says, or when your client, your real estate client says, I'm paying $375, they want me to buy $425 or $450 or whatever the number may be, don't be so shocked to think that's crazy. Because we're going off this replacement cost calculator to determine what we believe on the go-in based on the square footages, the age, the construction type, the construction style, the features in the house, what we believe the replacement cost is going to be. And in order for us to provide the insured the guaranteed replacement cost provision that everybody thinks they've got and certainly wants, then we've got to make sure we adequately cover replacement cost versus market value. That's a huge piece of the topic. And I know it's one of those that people don't love to think about, but it's what we have. Is the cost different if it's owner-occupied, rental property, seasonal, summer dwelling, multifamily? Yes. Well, yes it is. And why is it? Well, it's because to the insurance company, all of those things provide different exposures. Conceptually, if it's an owner-occupied house, the owner's there every single day, hopefully they're staying on top of the work that needs to be done, they're picking up the kids' toys, they're shoveling the walks, they're doing all those things that should be done. So from the insurance company standpoint, probably as minimal a risk as we can hope for. In the rental property scenario, well, the owner's not there. And no disrespect to any tenants out there, I'm sure they all do a great job trying to take care of the property as best as they can, but they don't have the same vested interest that the owner has. And I've owned several rental properties, and I've had great tenants, but when the tenant leaves, inevitably I find things that I say, why did they never call me on that? Why did they never let me know that needed to be done, whatever it may be? And obviously I take care of it, but you know, there are things that if I lived there, I'd have called my plumber, I'd have called my electrician, I'd have called my heating guy, whatever it was, the day I discovered it. Seasonal and summer dwellings, again, you know, the assumption on those is that on the go-in, they're unoccupied some percentage of the time. So consequently, when nobody's there, you know, it's kind of what we refer to in the industry as an attractive nuisance. It's where the kids are drawn to, it's where the kids play, it's what happens. So, and then multifamilies, again, same scenario. Not only are you trying to underwrite one family's habits and one family's characteristics, but now you've got multiples in there. And unfortunately, the results are not oftentimes very good on multis, so, you know, they're having to underwrite those differently.
Phil, those also change based upon like interior contents, which you don't necessarily need to have on the rentals and multifamilies, correct?
Sure, absolutely. You know, it's wide variation of costs as to, you know, am I renting it furnished, not furnished? Even with appliances, no appliances, you know, that kind of thing. So there's a lot of pieces.
The rental property is always cheaper for some reason. I have one that
They
always
can
a
be.
lot less than.
Yeah,
the
they
home
can be.
owners.
Is it generally just a fire? I think it's fire.
It's almost straight. We're gonna talk about that in just
All
one second. Yeah, and we'll go there now. You know, one of these that I put in, one of these super fancy deluxe policies, and I put that out there just kind of jokingly. But the reason is because what you're gonna find if you were to call 6 different insurance companies, they've all got a name to their policy. Oh, we got the super fancy deluxe policy. Oh, we've got the masterpiece policy. Oh, we've got this policy. You know, at the end of the day, they come down to an HO3, an HO5, an HO4, 6, DP2 and DP3. What do these things really mean? Well, the HO3 and the HO5 are 2 of the most common forms of coverage that we write on homeowners policies. The things that are in the contract language that we're going to pay for or not pay for. The HO4 is the tenant's form. The HO6 is the condominium form. And the DP2 and 3 are the dwelling fire forms for the rental properties. And the 3 is HO3 is an extremely good form, but the HO5 is better. It's what they refer to as, I always hesitate to really use this term, but they refer to as all risk. Nothing's all risk. Okay, nothing's all risk. But it's the broadest form you can possibly get. Even though HO3 is technically called a broad form. Crazy, I know. The 4 and the 6, again, are tenants or condos. The DP2 and 3, the 2 is essentially fire insurance policy, and the DP3 for rental properties adds in some other perils. Perils are those things we pay for. Fire, lightning, windstorm, smoke, water, hail, riot, civil commotion, you know, those are the perils, those are the things we pay for. And the 3 adds in more than the 2. So again, you've got somebody out there who's quoting a DP2 to somebody who's buying a rental property, and the rate may seem really, really good. But I'm quoting a DP3, and my rate seems high, but it's much better coverage. Yes?
Is that gonna be on your declaration form, like that?
It's listed right on the declarations
Okay,
page.
okay.
Yeah.
That I never noticed that,
Yeah.
unless I have to look at my.
Yeah, it's listed right on the deck page. Again, the different perils, the different types of coverages, the owner-occupied, the condominium tenant, so we don't do more. My client doesn't really need coverage if they're buying a condo, right? Wrong. I actually recently had a attorney who, I love attorneys, by the way, they're my favorite group of people in the whole wide world. actually say to a buyer at a closing table, why'd you buy an HO6, why'd you buy a condo policy, you don't need that. The association pays for it. And I nearly fell off my chair. Are you kidding me? Did you really just say that? Realize that when it comes to HO6's condominiums, the association is responsible, assuming there's a valid association in place, is responsible for ensuring the structures themselves. And in the state of Rhode Island, 99% of the bylaws I've ever reviewed or we've ever reviewed in the industry are what they refer to as bare walls. So they're going to rebuild that condo into the interior furnishings of the wall. The better associations even go so far as to say, and we'll actually rebuild the condo back to the place it was the day the doors opened. Well, this condominium was built in 1975. So they're going to put in, theoretically, 1975 stuff. But the owner, or owners since then, have done numerous upgrades. You know, and now there's beautiful hardwood floors, there's granite countertops, there's beautiful new bathrooms and kitchens, and it's a gorgeous unit. Even though it was built back in 1975, 95, whatever the number may be. This is called additions and alterations. These are changes that were made to the condominium since its original purchase, or its original build, I should say. Those are insurable to your client who's buying the condo, to our insured, to make sure that they can do those upgrades if and when it happens. Because again, the association's gonna rebuild that building and then say, we're done, see ya, have a nice day. And we wanna make sure that they can be back into that place. Remember, that's the concept, putting back into the place I was the night before the claim. We wanna be able to put them back in that spot. So additions and alterations is an option under an HO6 or a condominium form that allows the unit owner to ensure these upgrades that have happened over the years. And it's terrific. In addition, they also need to ensure their personal belongings. They've got stuff in the condo. And if the condo goes down, the association certainly isn't providing any coverage on that, so they've got to ensure that type of thing. We also have an endorsement called loss assessment coverage. It says, okay, every bylaws out there says that, hey, if we, the association, have a loss that is either not insured or not adequately insured, then we've got the right to reach back at all you folks called unit owners and assess it equally. So if there's 10 of us in here and there's a $100,000 loss that wasn't adequately insured, it's 10 grand apiece. You know? Yes?
So Phil, what about the building in Miami, those condo unit owners?
Oh boy.
That's an insurance nightmare,
Yes, it is.
obviously. Something like that, would the building insurance policy cover their personal belongings?
Maybe.
Maybe, it's a big maybe, right?
It's a big maybe. And the reason is, it all comes back to perils. Okay? There are writing articles, there are new articles coming out every day with that exact loss scenario at the top of the mind right now. The problem with this loss that happened in Miami is it all comes down to collapse. Collapse. And that's a peril that is very, very limited under virtually all insurance policies out there. And there are a lot of fingers pointing down there right now as to, was it a sinkhole? Was it a pure collapse? Was it a building defect? Was the building notified of the defects? There's so many allegations that are going on. And the unit owner's policy is probably going to follow what is happening on the building owner's policy. And they're going to say, I think to answer your question, this is not a decision, this is just a speculation. I think they're going to say, fine, on the contents, we'll pay you contents. But when it comes to your additions and your alterations coverage, if there's a loss assessment and that kind of stuff, we're going to sit tight on that stuff until we figure out what the real cause of the collapse was, and therefore, is anyone or who is responsible? And there's so many unknowns with that claim right now. It's that they're reading articles every day about it.
So at this time, I'm just using that as an example.
Right.
Those unit owners, they're being housed somewhere. Who is covering the expenses of where they're being housed? The condo's insurance?
Right now, nobody.
Nobody.
Right now, nobody, from all the articles I'm reading. Right now, everybody is sitting back saying, till we know what the cause of loss is, until we know who's responsible for it, or if there was coverage under the policy, we can't take that responsibility. So right now, those people are in a world of hurt. In a world of hurt. But let me preface, that's a very, very unusual claim scenario. You know, take that building and let it burn, heaven forbid. You get a whole different course of action going on there. The building policy certainly probably wouldn't, I say certainly, likely wouldn't even be questioning coverage. There's a fire is a basic covered peril. The additions, alterations coverage under the unit owner's policy is gonna pay, fire is a covered peril. The additional living expenses is under the unit owner's policy, probably gonna pay, because again, you can't live there because of the fire. So it's all, the uncertainty of that claim all comes down to the peril of collapse. That's the real problem.
It's gonna be an interesting outcome.
Oh boy,
And
it
it will affect
it'll be-
a lot of policies going forward.
I won't even be in the business anymore when that's all settled. It'll be time to be courts that long. And then of course, again, getting back to the condo owners policy, they've got a liability claim. They've got liability that, you know, people say all the time, I don't have any liability. The association owns the walkway, the driveways, and the lawns and all that stuff. But Anthony was coming to visit me in my condo when he took the header. No question I'm getting sued, not even a maybe. And consequently, if nothing else, I've got to defend myself. Never mind if I'm held responsible because my dog left a bone on the sidewalk.
I'd like to put on one caveat to that. So I think one of the major portions is, especially as a realtor, is figuring out whether there's walls and coverage immediately. As Phil showed in the beginning, the longer the time frame of them buying insurance, the usually cheaper it's gonna be for them. So if you know as a realtor from the get-go, from your sellers, and then if not from them, contact the HOA association to find out whether or not that condo has walls and coverage or not. Most, like you said, do not in the state. There are several, a few that do, but very limited. If they don't, the quicker you can give that information to your buyer, or give it off to the buyer's realtor too as well, actually will help you strengthen that side frame as they're going through. They'll be able to get insurance earlier and usually at a discounted price because it's been so far from the closing date.
So let's look at, you know, what am I really getting under that $400,000 policy that I'm buying? Your homeowners policy is broken out into a number of coverages, A through F. And again, I'm trying to talk about, this is not stuff, by the way, I should have prefaced this earlier. I'm not suggesting you should try to counsel your buyer in the insurance world, okay, as in what's covered or not covered. It's not your job, all right? There are people a lot smarter than me, that have been in the business a lot longer than me, that know a lot more than me, that we still try to do it every day. So don't put yourself in that position. However, you know, I'm trying to take it from the standpoint of, you know, let's look at your homeowners policy so that you better understand, because then you'll be able to better talk about it. So we've got the $400,000 policy. That's what we call coverage A, that's the building coverage. It's the main building and everything attached there too. So if you all of a sudden take that one-car detached garage and you put a canopy between the house and the garage, that now became part of the building coverage. Okay, so it's the main house and anything physically attached there too. But in addition to that, we're going to give you some additional coverages. First is coverage B, or other structures coverage. Typically, that's 10% of whatever your dwelling, coverage is on your house. So if you get a $400,000 house, that might be $40,000. Now again, I go back to my first disclaimer. Somebody's gonna say, oh, my company gives me $80,000. My company, okay, fine. Typically, it's 10%. That's generally the ISO rule of thumb. This is for your shed, your outbuilding, your pool, your fences, you know, all of those things that are out in your yard, not contents-wise, but structure-wise, that may suffer damage. They're also going to throw in coverage C, contents. And I note here that that's typically between 50 and 75% or 70% of the replacement cost. So in this case, I put in 280,000. Contents we want on a replacement cost basis because that allows us to pay to replace the contents new for old. We're not going to say, well, the couch was 10 years old, or the TV was 8 years old. We're going to say you had a 42-inch TV. It's going to cost X number of dollars to replace the 42-inch TV. All right, or you had a living room set that you bought at Cardi's 15 years ago. We're going to go back to Cardi's and we're going to buy another, give you enough money to buy another living room set that, you know, is of similar kind and quality. Yes.
So Phil, with that content, you mentioned like a 42-inch TV, would you have to prove that you
Replace it?
purchased, yes?
Yes, yes.
So
Great
you
point.
have to keep those receipts?
Yeah, great point. Well, do you have to prove you had it in the first place, or that you replaced it?
That's my question, actually, that's a good
Both,
question.
both things.
Both.
Yes to both. Let's start with do we have to be able to prove our loss? The answer is yes, we have to be able to prove our loss. You know, the insurance industry knows pretty well what your average $400,000 house has in it. But the minute I say, and I had a 6-foot TV that monitored Russian television channels 24/7, because God, I get off every night, I watch a Russian TV, they're gonna say, well, you know, Phil, I'm sure you do. We've heard about you. But, you know, we'd really like to see your receipts for that, or where you bought it, or something of that kind to be able to prove your loss. The easiest way to prove your loss today is, I've left mine over there, we're all carrying around. It's our phone. Go around your house once or twice a year and just videotape each room. And when you hit the bigger things, just say, and there's my 42-inch TV, and there's my living room set from Cardi's, and then whatever it may be. Pretty indisputable. You put that in the hands of the adjuster the day after the claim, I don't know, adjuster out there's going to give you a hard time. You know, it's pretty clean. In the old days, we used to say, keep your receipts. You know, we want to see makes, models, serial numbers, the whole 9 yards. You know, certainly that would be lovely. But again, you have a video of your house, date stamped twice a year, 3 times a year, whatever it may be, they're going to accept that all day long.
What if that's in the house that burned down?
I'm sorry?
What if that's in the house that burned down?
Yeah, there's always that risk, and that's why we used to say photographs. And we don't say photographs, we say put it on your phone, that hopefully is out in the cloud, that, you know, that kind of thing. But yeah, it's got to be attainable, no question. But again, even if somehow it's not, just my experience tells me that they're not going to drive into the ground by any means the stuff that is relatively normal, typical. It's the unusual stuff that they're going to say. We really need some help with this kind of thing. So your contents, again, could be between 50 and 70% of your coverage A amount, but they want to be looking at the replacement cost provision to make sure they're getting a replacement cost there as well. I should actually go back to the coverage A because remember I did the replacement cost estimated. That's how I came up with the 400,000. That's what entitled me to get replacement cost on coverage A on the building itself, because we want to make sure we get that as well. Coverage D is 80,000, typically 20% of the coverage A amount. That's your additional living expenses. That's where, let's make it happen in your house, heaven forbid, and the house is not livable. The insurance company's either going to bring in a trailer and put it in your yard, or they're going to put you up in mainstay suites for 6 weeks while their work's being done, or whatever it may be, and they're going to pay your additional expenses that are going to cost to continue to live. Now remember that they don't pay, your mortgage is still due during the period the house is being repaired. They're not going to pay that, because you would have paid that anyway. But they're going to pay for you having to eat out every night, and the cost of the room, obviously. The cost of the laundry services, because you would have typically done it in your house. So they'll pay all of your additional living expenses, should something happen. So again, your $400,000 house goes to the ground, and in theory, the insurance company's gonna write a check for, what is that, $680, $760, almost $800,000. for that $400,000 policy that you bought. It's a lot of coverage thrown in here. And it goes back to my original point of, why are we asking all these questions? Well, we're asking all these questions to make sure that we've got the coverages that we need to properly provide the coverage. And I get it, the old adage all the time of, this is never gonna happen to me. I know it's not. I know it's not. This is never gonna happen to you. There isn't a year that goes by that I'm not out in a house that burned to the ground on Thanksgiving Day, on Christmas Eve, on New Year's Day. Anthony's wife works for me. She would attest to the fact the emergency line goes to my cell phone. I respond to those claims 24/7. And I've been out to hundreds of them with crying people with their houses destroyed at the worst possible time. You know, it's what the policy is supposed to be there for. So, again, those pain in the neck insurance agents who are asking all these dumb questions, they're doing it to try to build a package of coverage that responds properly when the thing that's never gonna happen to you, unfortunately happens. In addition, we throw into the homeowners policy coverage E, which is liability. The basic homeowners policy comes with $100,000 liability built in. Then you have the opportunity to increase it to say 300,000, 500,000, sometimes $1 million, depending on the carrier. To go from 100,000, the given amount, to $500,000 with most carriers, it's less than $25 a year. So don't shop on price alone. Right? You want to make sure you get good, adequate coverage. Coverage F is medical payments coverage. I put in 5,000. You could see it anywhere from 1,000 to 25,000. Medical payments is slip and fall coverage for something that happens in my house that I may or may not be legally responsible for. Okay. Liability, we're going to prove that I'm responsible. If I'm responsible, if the court would have said I'm responsible, liability is going to pay. But, you know, you fell down my front stairs. There wasn't a bone on it, there wasn't a toy on it, it wasn't not shoveled. You just took a hit of Anthony, your klutz. Now the insurance company's got two options. And it could be that too. You got two options. One is to say, gee, Anthony, we're really sorry about that, but you're a klutz, have a nice day. And then he's gonna go to Uncle Leo, the attorney, and Uncle Leo's gonna sue for $87 cajillion, just cuss, and see what happens. Or two is they can say, look, Anthony, you had to go to the emergency room, you had to get your ankle x-rayed, you had to have it taped up, you lost a couple of days' work, here's you know, $1,000, $2,500, $5,000, whatever it may be. We're not accepting responsibility, but we'll say in goodwill, we'll take care of that for you. So medical payments is cheap kind of goodwill coverage. And again, remember that both liability and medical payments are not for you or your household members, they're for guests. They're for guests.
If guests burn the house down.
If the guest burns the house down,
Yeah.
again, it's also not intentional.
Is that on them or me?
It's on you. As long as it's not intentional. Don't even get me started on the arson claim, so I can tell you stories then. Deductibles. I would say the standard homeowners policy these days, if there is such a thing, comes with probably $1,000, what they call all perils deductible. So it means anything that happens, you want to take $1,000 off and pay you the difference. You can get deductibles as low as, some companies still do $250, but call it $500. You can go to $5,000, $10,000, $20,000, you know, I mean, you can go as high as you're comfortable taking on. And my basic premise on deductibles usually that I say to my clients, take on whatever you're comfortable with from the standpoint of, I've got to dip into my savings account today. How bad would that hurt? If you're telling me 1,000 wouldn't hurt that bad, then 1,000 is where it should be. If you tell me 5,000 is always available, take the 5,000, reduce your premium. And, you know that if something happens, that's what it'll be. Excuse me. Because we try to, in all reality, discourage insureds from thinking about their homeowners policy as a small claim policy anyway. You know, insurance companies get real concerned about two things: frequency and severity. Frequency and severity. So we as an industry, have seen countless policies canceled because they had 3 $500 claims, $750 claims, $1,000 claims. Because the insurance company says this person's conscious of claims. They're always looking for somebody else to pay for their problem. A lot of times these things are deferred maintenance related. And you know, it's only a matter of time until we get bigger. So they cancel the policy. Versus my house goes to the ground tonight and they realize that was just luck of the draw and we'll live with that one. Versus, you know, a couple of other larger ones. So claims frequency and severity is the 2 things that they look at regularly. Then we really skated 3 days ago, 4 days ago, whatever it is now, on good old NRA, with our hurricane deductible. And hurricane deductibles is something that sadly I believe most people don't understand. But a hurricane deductible is a percentage deductible, could range from 2 to 5%. I've seen them a few higher, but most 2 to 5%. And it's 2 to 5% of your amount of coverage provided, not your claim. So a 2% deductible on a $400,000 homeowners policy, if Henry had caused damage to your house, was an $8,000 deductible all of a sudden. Not 2% of the $10,000 worth of damage that you have. So 2% of the hurricane deductible is applicable to the amount of coverage limit, not the damage you had. There's a company out there that I'll leave nameless that takes this hurricane deductible and applies it to each of your coverages, A, B, C, D, separately. So that you can have 2% of your coverage A, 2% of coverage B, 2%, depending on what damage is caused by the hurricane. Most carriers that I've seen are only applying it to the coverage A limit, not B, C, and D separately. But as I said, there is one major carrier who applies them separately. This is going to be a real awakening to people when we do have, I'm not even saying if, because you know it's just in my mind, it's a matter of when. We do have a hurricane actually in the state. Had Henri continued north from Block Island and made a westerly landfall as a Cat 1 or whatever, it would have been Cat 1 at that point, made a westerly landfall at Cat 1, everybody's hurricane deductibles would have kicked in at that moment. Versus being downgraded to tropical storm, they didn't. So the hurricane deductibles are going to be a big awakening to folks if and when this scenario occurs.
So Phil, because Henri was a tropical storm, categorized as a tropical storm, if there was damage to someone's home based on that tropical storm,
Based on the tropical storm, it's going to refer back to the basic deductible, the all perils deductible.
oh,
Had
okay,
it stayed as a Cat 1 hurricane, it would have gone to percentage deductible.
okay,
That's different in Rhode Island than in many states. Many states are calling these windstorm deductibles, not hurricane deductibles.
yes,
So any wind, including just a windy day,
right,
a
and
nor'easter,
windstorm,
is triggering these deductibles. That's not the case in Rhode Island, but in many states that is what's happening.
Would tornadoes fall under windstorm? We've had more tornado recently in the northeast.
Yeah.
Come on, so that would fall under that
Same
same.
thing.
Okay.
We don't have that number.
I'm sorry?
We don't have.
Well, a
No,
tornado.
because
Yeah, it's still-
right,
it's still-
they don't carry us forward.
so 2 to 5%, give me an example.
Again, let's use Henri. It stayed Cat 1 hurricane. You had $20,000 claim on your house. Took the roof off, caused some water damage, that type of thing. But you have $400,000 in the house. 2%, if you have 2%, would be $8,000. Insurance company's gonna pay you $12,000. But not 2% of your $20,000 claim that would have in theory been a $400 deductible. That's what people want to think it is, but it's not what it is at all. If somehow you only had damage to your contents, it'd be 2% of your $40,000 limit with most carriers.
So it's interesting, Bill, that, you know, insurance companies are doing this with hurricane, windstorm deductibles. What about these wildfires out in California?
It's, you know, the funny thing is, I can tell you, having been in this industry for 40 plus years in New England, it's hard for any insurance company's numbers, the profitability to look really good when we're down. Because we're so small, relatively speaking, and I love this state. So that's not a criticism of the state. I'm born and bred in Rhode Island, I'll be here for my entire life. I love this state. But it's hard because there's enough, the insurance is built upon the law of large numbers. Let's throw everybody's premium in the bucket. Let's reach in and grab what we need to pay those claims that we don't know who's gonna have. At the end of the day, hopefully there'll be something left in the bucket. Well, at the cost of construction and the cost of liability suits and all of these things today, there isn't enough going into the bucket to pay the claims to make it profitable to the carriers. That's a unique problem to Rhode Island. But when you look at the industry overall, you almost can't go anywhere and not say it's got its unique characteristics of exposure. Yes, in Rhode Island or in the Northeast, they have panicked about the hurricane that might be coming someday, and the hurricanes that have been here in the past. They really get killed regularly over frozen pipes. I mean, that's a real common claim scenario that we see a lot of. But take out of Florida, you know, Florida, your homeowners policy doesn't provide you hurricane coverage. You have to buy it separately. It's extremely costly. Out west, they got the fire problems. In the Midwest, they got the tornado problems. So everywhere you go in the country, and having studied policies from across the country to some regard, they all tweak themselves for what the greatest exposure is in that area. Again, use Florida as the easy example. They just pulled hurricane right out of the mix and said, you want hurricane, you can buy it separately. And they were a whole separate policy tailored for that.
Sometimes higher than their mortgage payment already. I've
Oftentimes.
seen several Florida properties.
So perhaps in
Ridiculous amount of monthly
California, if it's a wildfire, it's probably a different category as your house
Yep.
burning
Absolutely.
or something other
Burning
than
from
a
some other
wildfire.
cause. Right, exactly. Absolutely so. I got a comment down here at the bottom, always beware of exclusions and limitations. You know, every policy has them, I don't care what policy is, which is why I said earlier, I hesitate to call it an all-risk policy, because nothing is all risk. People always say to me, you know, what are you talking about, exclusions and limitations? Well, two of the biggest, you know, in the homeowners and property policy, are flood and earthquake. Flood, we were talking about earlier, but I think before we went on camera, is to the fact that you can, and if you're in a flood zone, elevated flood zone, not a flood zone everybody is, an elevated flood zone, you are typically required by your lender to carry flood insurance, how difficult it is to get it, the costs involved in it, the changes that are gonna be coming down the pike in the next 45 to 60 days are substantial, some good, some bad. But flood is one of those things virtually no homeowners policy is gonna provide any coverage for. Keep in mind, flood is very different than a wet basement. Okay, people always say, oh, you know, there's no coverage, you're excluding my wet basement because of the flood. No, it wasn't a flood. Flood is water above the ground, the surface of the ground that is not typically there, impacting more than 6 consecutive properties in an area. That's flood. My wet basement, the water came up from underneath. And that's not covered anywhere, virtually anywhere. The homeowners policy doesn't provide coverage for it. I don't know of any company that offers it as a buy separately endorsement. It's one of those things that they can't underwrite. Insurance companies don't like things they can't underwrite. If they can't figure out how to calculate what the potential exposure is, they get really antsy. And they can't, because you could be in that house for 30 years and had bone dry basement. All of a sudden, the spring underneath the house that you don't even know exists turns a little bit, and all of a sudden now every time you get a half-inch of rain, you get water in the basement. It's excluded. You're not going to get any coverage for it. I'm not aware of it. Just going to buy it. Limitations. Limitations are things like money, jewelry, furs, cameras, musical instruments, all of those kinds of things. Because, you know, people say to me all the time, why do they limit that stuff? Well, if they didn't, everybody would have $10,000 in the house at the time of loss. I keep my money in the house. I mean, it just would happen. You know, if you're a musician and, you know, your basic musical equipment is covered under the homeowners policy, but the minute you take it out and go perform with it, it's not. Well, it's because when you're performing with it, it's under a different level of care. You're getting distracted by what's going on at the bar, you're getting pulled away with this person over here to do that. You know, it's a different exposure than it is when you're using it in your house. Jewelry, you know, jewelry is a great example of the homeowners policy gives you a little bit of coverage on your jewelry. But ladies, I ask you, what's the biggest risk you got? And you look down at your finger and you see you got a beautiful ring still there. The thing that used to be in the ring is gone. Right? The stone fell out. You know, you don't realize you loosened the prong, you making the bed this morning, or whatever it may be. And that, to the insurance company, is called mysterious disappearance. Wasn't stolen, wasn't destroyed, wasn't crushed, wasn't burned, wasn't any of those perils we insure against. It just disappeared. So now the only way to get coverage on that is to specifically schedule it and say, okay, insurance company, I'm willing to pay a little extra money, but if something happens to this 5-carat rock my husband bought me, I want somebody to reimburse me for it or to replace it. And for that, they then turn that into the broadest form of coverage you can, providing that type of coverage. So again, we try to counsel our insureds on nothing covers everything. There are certain things you gotta know are just excluded, and whether you buy them or can't buy them, they're still not there. And there are things that are limited. Do you have musical instruments? Do you have jewelry? Do you have furs? Whatever it may be, because we want to make sure that they're properly protected. You see, I hope that you all, I know you all, have the concept of clients for life, right? We all want to maintain a relationship with these clients. We all want to make sure that as of the day of the closing, there are hugs and kisses and everything's going on great, but you're going to try your best to stay in touch with them for the future business that's going to come your way from this real estate transaction. That's what we should all be doing. That's what we all step out every day to make sure we do. But on the insurance side of the house, we're going to live with these people, hopefully long term. We're going to renew their policy year after year after year after year after year. So again, beyond whatever we've got to give the lender to satisfy the closing, we're trying real hard to build their protection long term to say, look, something may not happen right now, but if it happens 3 years from now, 5 years from now, 10 years from now, and you pick up the phone, the last thing in the world I want to say to you is, no, it's not covered, or no, it's limited in some way. I really, and insurance companies, believe it or not, they get a bad rap. I'm not here to defend insurance companies, but I know they do get a bad rap. But they really would rather have on property insurance, they'd rather pay everybody everything they want, because it's just it's bad will. You know, nobody runs around town saying, "Well, the insurance company was great; they gave me only half of what I thought I should get." You know, I mean, so it's different than a liability claim. There's a defending responsibility. On property, they really do want to be able to pay you everything you had, but they're going to go back to this, and they're going to go to all of these pages here. And they're going to say, but at the same time, we got to be fair to everybody and say, what does this tell us we have to pay? And they're going to look at it from that standpoint. Should they buy based on price? Well, no. The answer, never. I know they need a good rate for the closer. I get that. I know it impacts their escrow. I get that. I know from a lending standpoint, they've got to keep these numbers in certain ranges to make all the numbers work to get this loan clear, closed, and finally approved and ready to roll. I get it all. But if you only buy by price, you get what you pay for. And that's typically not what you want the day a claim happens. Different types of agents, and again, this is another one of those things that you as realtors, I hope, know and can have the conversation with your client about. That, okay, you're gonna send them off to get their rates, you're gonna send them off to get quotes, you're gonna try and encourage them to do as soon as possible to get those early quote discounts, to get an opportunity to really think about what people are giving them for coverages and all that kind of stuff, but also, where did they go? Well, I know we all get very cautious, and rightfully, about recommending any one or even a couple of places for your clients to go. I would urge caution in that regard every time. But understand the systems to get a quote in the insurance industry. One is what I do. It's called the independent agency system. And that is that I run an agency and I represent about 15 different carriers, and I try to match those carriers with the best possible rates and coverages based on what the customer's needs are. And there's thousands of independent agents throughout the country, thank God, and there's hundreds throughout the state of Rhode Island, and a lot of us have a lot of the same companies, but a lot of us have different carriers as well. And again, when I get that call from you, and you answer all of these questions that we've been through so far today, and I try to match that up with which carrier is going to match best, is to determine who can get us the best rates and coverages. But I'm looking at probably all 15 of my carriers, versus what they call captive agents. Captive agents are agents that represent one carrier. Typically, they're big name carriers. You see their commercials on television, and they are designed around the system that their agents are really employees for the company, and they sell for that one company, whoever that may be. They may be great, and they may be very responsible agents, and they may be given the best advice and counsel possible, but if there's only one thing, and this sounds critical, I'm not being critical at all, they're wonderful. They're local, they've got a lot of great things to offer, but they do only have one thing on their menu, and that's just a reality. So if you get a quote from somebody who only represents one carrier, they're giving you the best quote they can with that carrier. And then you've got the 800s that are out there, and I'll be the first to say I'm not the biggest fan of 800 anythings in any industry. I believe in local relationships. I believe in the ability to sit down with people and get counsel and ask questions and get advice. But a lot of folks prefer to dial 1-800, whatever the insurance company's number is. And again, they're going to provide you quotes at whatever is their company. So it's, again, somewhat limited as to what options they have available to offer. And you're giving up that ability to have that local relationship that many people prefer to have. I'm not suggesting for a moment any of them are better than another. Obviously, I'm an advocate for, and I love the independent agency system. But if I had a colleague in here that owns a captive agency, he'd tell me that he or she has a great system there, and I'm sure they do. And if we called in somebody from some 800 carrier, they'd say they've got to figure out at a whole different level, and man, their technology is off the mark, and you can change your policies and service your policies every which way going by touch of a button. Sure they can. So again, I'm not advocating one for the other, just from your standpoint. If you're talking to your clients, help them to understand that there's a bunch of different options out there to get the best possible quotes available to them in the industry. Short of that, as realtors, how do I guide them? Well, again, be proactive and encourage them to get the quotes as soon as possible. Encourage them to find the agents that are giving them the best guidance and binders and quotes and payments and documents in the most efficient fashion possible. I'm sure I can speak for Anthony to say there's nothing more frustrating in the world than when they're pushing to try and get a closing date, they're pushing to try to get that clear to close, and they're dealing with some insurance carrier out there who's either producing binders that don't have the right wording, or they're not producing quickly enough, and everything's down. We know, I understand. I own an insurance and real estate company. I know everything's down to the days. And if they don't have it by 3 o'clock this afternoon, your closing for 3 days from now is off the table. We'll chat again a few days after that. So I get it. And I think that's the agent they want to be searching for, is the ones that understand timing's everything. This is a funny business, this real estate business. Everybody gets excited to find a new home. They get all worked out, they get through the inspections, and then it goes into the silent phase when everybody else is doing their jobs. And then it comes out of this silent phase and everybody's like, and we're closing the radiation now. And everybody's gonna jump. And if you get somebody who's not jumping at the same level that the others are, it can become very frustrating very quickly. So just try to make sure that your clients work with people who understand they're part of a team effort here to get them the best service they can possibly get. Short of that, I've done a lot of talking, way too much talking. Hopefully I said something that, helped in some way, made you think about something a little differently than you thought about it before. There's books full of stuff I didn't cover. So, I mean, this is not insurance all-inclusive, there it is, have a nice day. But I tried to take it from a very consumer-oriented perspective to say, what should you look at, and thereby what should your clients maybe look at. Who has other questions that we haven't already talked about, or thoughts, or observations, or who just wants to get pizza and get out into 92-degree temperatures?
So, are there other aspects besides knowing whether somebody has walls and inclusive policy that maybe a realtor should be asking the questions at the initial phase so they can help their consumer set up that policy a little earlier?
I would say as much as anything, they probably would come back to the systems updating, the systems questions in my mind, because that's what the customer is going to be asked, and this isn't the house yet, or the condo, or whatever it may be. So when we're pressing for how's the heating system, how's the roof, how's the plumbing, how's the electrical, oftentimes that's very overwhelming to the customer. And particularly if they haven't even had a home inspection yet, but if they have had a home inspection, again, still trying to keep all this information clear in their heads. And somebody would say, just have the home inspection, give the home inspection report to the insurance company. I would probably say to that, probably not. Don't repeat that. But I probably wouldn't do that any more than I give it to the lenders. All right, just know the information, So the updating of the systems, I think, is probably one of the big keys. Yes.
Yeah, so Phil, I would think as well, first-time home buyers probably need a little more hand-holding because it's their first time, as opposed to, a buyer that's purchased in the past.
Right. They certainly do, and I can tell you from my realtor's standpoint in-house, to this day, I have been blessed to be involved in some very big real estate transactions and blessed to be involved in many, many first-time buyers. I say to folks all the time, to me, the first-time buyer, whether it be real estate or whether it be insurance, they're the most rewarding. They're the most fulfilling. I personally love them the most because they want help. They want our professional guidance. They want us to be able to help them through this path. Because ultimately, at the end of the day, they want to stay safe. And if we're not giving them the counsel that they deserve, then it's shame on us. So I hope that everybody's doing it. So I love first-time buyers of insurance or real estate. Yes.
If you buy a home warranty, does that affect your insurance quote?
No, it doesn't affect your insurance quote. Most of the time, the home warranties, for the most part, are on the systems.
Right.
Not always, but most of the time.
Right.
And most of the time, they are based around maintenance. And your insurance policy isn't going to pay maintenance anyway. So your heating system and one of the pipes on the heating system breaks, clogs, whatever it may be. Your homeowner's policy isn't going to pay for that. It'll pay for damage from it. It's not going to pay for damage to it. So consequently, that's what your home warranty is going to take care of.
Right, so if I have something that will take care of the home systems, whatever it is, wouldn't that lower my, no?
I know in theory it would, it
Okay.
should, but again, it really comes back to, they're gonna pay different things. They're gonna pay for different things.
Right.
That, again, I use the plumbing example. The elbow breaks on the pipe leading to my heating system. All the water that comes from that and causes damage to my basement, my bedroom, whatever it is, that's covered under my homeowner's policy. The elbow itself, and the plumber fix it, is covered under the home warranty policy,
Okay,
not the homeowners.
okay,
So they're kind of covering different pieces of it.
okay,
And even then, that policy is covering only so long. So your insurance policy covers you for that, or on the renewal basis from that point forward.
right,
So
right,
that's really in the first year that you're covered
yeah,
for all of those mechanicals that went wrong. So the hot water
Okay.
heater goes, it's gonna replace the hot water heater.
okay,
Like you said, the work that gets done directly from it for the hot water heater, all that water rushed out, damaged your basement, now you have a claim.
okay,
So it does something different directly to it.
okay. Thank you.
Phil,
Yes,
did you take into account like the fire hydrant, like where it is in the, because I have one right across the street from you, so try, look, I mean,
yeah.
does that help?
We used to have this running joke that we'd have a portable fire hydrant, and we would just in front of every house we could show.
It does help, it does help.
Every town has its own rating,
Uh-huh,
every town has its own rating, and basically, if your house is in one of the towns that has a fire hydrant within 1,000 feet, it's rated as a protected class, and you're gonna be in the best possible scenario. If you have very few towns in the state, only a couple I can think of, have city water for fire hydrants over 1,000 feet, because if they put city water in the street, they drop a fire hydrant every 1,000 feet, so anyway. And if you get to the towns that don't have fire hydrants, they don't have city water and well water, or volunteer fire departments, those are rated as unprotected. And again, go back to the insurance companies, only certain insurance companies will even entertain those properties.
so you know, you have that data already.
Data's already in this,
Oh, okay.
yeah, it's already built into the systems. Again, it gets more complicated when you get to the Midwest or some places of the South, but here in Rhode Island, it's pretty cut and dry. Either we get a paid fire department, city water, or we don't.
Can I say something? You know, in Raleigh, a lot of those old Victorians, when it comes, if there's a damage there, in my neighborhood, I have an old Victorian and it burned down and they built one smaller. They don't have to keep the structure, you know, try to make it, no.
The policy says that it's gonna replace what was there, except the Victorians are a real bad example of that. Because, you know, in the purest of sense, if it's, let's say it's a turn of the century Victorian, gorgeous architecture, gorgeous structure, off the charts. You can't even buy the materials that are in that building today that they built that with. So to say we're gonna replace it would be fallacy. There's no way we even could have wanted to. So consequently, the policy says it's going to pay to assist you to replace it with a similar structure. It may have the outside appearance of that Victorian structure, but it's not gonna have actual 2-inch by 4-inch or 2-inch by 6-inch boards, because a 2x6 today is 1.75 by 4 3/4. You know, I mean, it's just, there's nothing we can do to change that. So it's gonna say, we're gonna assist you to build something that looks similar to. A lot of times people will say to me, I would never rebuild our house anyway. You know what, if it burned to the ground, I'd build a 3-bedroom ranch, because my kids are all gone, that's what I want. And that's not what the insurance policy is designed to do. It's designed to put you back to where you were. When you sell it, when you call one of the wonderful realtors here in the room today to sell it, then go buy your 3-bedroom ranch. But it's not, if you insist on, don't pay me to build that 4-bedroom, 3.5 bath colonial because I want to build the ranch, then they're going to actually take away the replacement cost and they're going to base the loss settlement on what's called actual cash value, which is replacement cost minus depreciation, and they're going to give you a discounted number.
So just walking away, that would happen. Someone just wanted to walk away from the lot and sell the lot eventually and do it that way.
Sure. Anybody have questions?
Thank you very much.
Cool, thank you very much, I appreciate the opportunity to sit with you.
Thank you.
Thank you very much again. Great knowledge as always. There's a survey for everybody. Directly here, please fill it out. Anybody at home, feel free to email us directly at Kent Washington.
And the survey's online.
Oh, we have the surveys online.
Yes, it is.
Technology. So we have the surveys online, so feel free to fill them out. Any ideas for any of our future lunch and learns are always accepted. And of course, seeing you guys.
Before you do the survey, my feelings get hurt really, really. I'm a sensitive guy, so.
Very sensitive.
Thank
I always say that about
Yeah,
him.
exactly.
That sensitive film.
Well, your wife says all the time. Thank you all, I really appreciate the opportunity.